I'm Harold Black of American University, and this program is sponsored jointly by the National Economists Club, Educational Foundation, and George Washington University. We are going to have a panel discussion today on monetary policy. And we're very fortunate to have with us two individuals to discuss this. They are, to my right, Lyle Gramley, who is Chief Economist of the Mortgage Bankers Association. He received his PhD in economics from Indiana University and joined the Federal Reserve Bank of Kansas City as a financial economist in 1955. In 1962, he left to join the faculty at the University of Maryland as an associate professor of economics. In 1964, he became staff economist at the Federal Reserve Board and subsequently the director of the board's Division of Research and Statistics. In 1977, Mr. Gramley became a member of the President's Council of Economic Advisors, where he continued into his appointment to the Federal Reserve Board of Governors in May 1980. He served as a member of the Federal Reserve Board of Governors until September 1st, 1985. On my left is Lawrence A. Fox. Larry is Vice President for International Economic Affairs at the National Association of Manufacturers. Prior to joining NAM, he was senior official of the U.S. Department of Commerce, serving as head of the Bureau of International Commerce, the predecessor agency to the International Trade Administration. Mr. Fox is a member of the State Department's Advisory Committee on International Investment, Technology, and Development, and represents U.S. business in international policy discussions and negotiations. Mr. Fox is one of those unusual individuals in that he is a lawyer and an economist. He is a graduate of Clark University, has a master's degree from Syracuse, has done some advanced work at Harvard in economics. He holds a J.D. degree from George Washington University, a member of the D.C. Bar, and was adjunct professor of economics at George Washington University. Now, just some brief background about the Federal Reserve and monetary policy before turning it over to the panelists. A previous Federal Reserve chairman, William McChesney Martin, once was said to remark that they took a poll and asked people what the Federal Reserve was. And 1/3 of the people answered an Indian reservation. 1/3 of the people answered a bourbon, and the other third of the people didn't know. Now that was back in the 1950s. That's no longer the case. The Federal Reserve is a body that everyone is familiar with, but very few people are intimately familiar with. Indeed, one of the arguments raging in economics has been what determines the monetary policy of the Federal Reserve? Can it be predicted? And invariably, you get as many answers as you get observers. There's a tremendous amount of confusion there. There is also a tremendous amount of confusion as to the impact of Federal Reserve policy on macroeconomic variables and upon our well-being. I am certain, however, that those of us who are confused as to the Federal Reserve policies will find that confusion taken away by what Mr. Gramley will tell us. However, let me preface his remarks by saying that I've asked Lyle and Larry to talk about the impact of monetary policy domestically and internationally from a brief historical perspective first. Lyle?
Well, let me start by saying that in the fall of 1979, an historic decision was made in the Federal Reserve to concentrate its primary emphasis on bringing down inflation and to target on the monetary aggregates closely as a means of doing so. And I think that policy has been highly successful. We've seen the inflation rate come down from double-digit figures in the late 1970s, early 1980s, down to a figure of 4% now. But that achievement was very costly. It came largely as a consequence of the fact that economic growth was slowed for a protracted period, and the unemployment rate went up to as high as 10.75% for a while. Around the middle of 1982, the focus of monetary policy began to shift. We were then in a recession. The world economy was in a recession, and there seemed little promise of getting out of it unless the U.S. economy began to turn up again. And so the Federal Reserve began to focus, in the short run at least, on providing enough money and credit, enough expansion in money and credit to get the U.S. economy moving again, and in the process dropped the principal monetary aggregate M1, the narrow money supply, as its principal target of monetary policy, and switched to the broader aggregates as targets. And I think it's fair to say that while the Federal Reserve continues to express concern, and I think rightly so, about making sure that they keep their eye on bringing down inflation and holding it down over the longer run, the principal thrust of monetary policy since the middle of 1982 has been to be looking towards short-term economic growth, the performance of the economy, and doing what is necessary to keep the economy moving ahead. We saw, I think, a classic example of that in 1986. We had 4 cuts in the Federal Reserve discount rate from 7.5% down to 5.5% between January 1 of last year and August 21, indicating that the Federal Reserve was not satisfied with the economy's performance. Now, our economy did grow relatively slowly last year, 2.1%, fourth quarter to fourth quarter. I think the Federal Reserve's concern, however, was less with the adequacy of growth at home than it was the adequacy of growth worldwide. The industrial countries around the world are not growing rapidly. They're not growing rapidly enough to give the developing countries an opportunity to make payments on their debt service from earnings through exports, and consequently the Federal Reserve would like to see a more rapid expansion of world output and of world trade. Since August 21 of last year, they've been sitting on their hands. Other concerns have come to the fore, and I'll talk more about those when we get into the present.
All right, thank you. Larry, what about the international scene?
Well, I think that's a very good introduction that Lyle gave us, and I'm glad he referred to the international dimensions of monetary policy as he did. The interaction of our economy with the economies of other countries can be expressed in a number of ways, but perhaps most directly in terms of the exchange rate. The exchange rate basically determines the relationship of the value of our currency in terms of another currency, and has quite a bit to do with what we pay for what we buy and what we get for what we sell. Well, one of the consequences of the actions that Lyle described in 1979 and 80, of course, had a strong bearing on the value of the dollar, which rose dramatically from 1980 to 1985 and to the present in some respects. And the very high value of the dollar, of course, impacted our economy very greatly. It brought about, not exclusively, but had a very strong influence in bringing about the huge trade deficit that we're now experiencing. Last year, that deficit was about $170 billion, about 85% of which was in manufactured goods. The consequences of that deficit can be seen in various ways, but perhaps the decline in industrial employment is one of the most obvious manifestations of that exchange rate development, although there are others. I would say that the United States has not been very successful in managing monetary policy if you take as the test the consequences for our economy in this interface with the rest of the world as an important part of that test. A trade deficit isn't necessarily bad, although one that's quite as large as we have now has consequences in terms of lost growth ultimately in terms of the standard of living of the United States, because the size of the trade deficit, read that to mean current account deficit, has to be paid for by borrowing abroad, and in the past several years we've become the largest international debtor. We'll have to pay taxes of 45 billion to 60 billion if you translate that debt into interest costs, and of course the only way we can do that is to turn this trade deficit at least into a zero figure, or possibly we will need a trade surplus. The exchange rate will have quite a bit to do with that. At the moment, the course of exchange rate policy probably means further devaluation of the dollar, changes in the terms of trade, meaning we will pay even more for what we buy and get back even less for what we sell. That will have an impact on our standard of living, and I think the formulation of monetary policy in the Federal Reserve, and of course it's not limited to the Federal Reserve, it affects the Treasury and the rest of the executive branch and the Congress as they relate fiscal policy, meaning the budget deficit, to monetary policy. But the interaction of these matters with monetary policy and the trade account of the United States will have a lot to do with the standard of living that we all have from here on out.
Before opening this up for questions, I think I'll put you two on the spot. I want you to give the Federal Reserve a grade. I want you to tell me what your grade of Federal Reserve performance is and by what criteria. And we have just a few minutes for that.
I should perhaps start by saying that I have a tendency to a bias, since I was with the Federal Reserve for so long.
But you're no longer there, so you
That's
can...
correct, but
Yeah.
I still have a great deal of affection for that institution. Let me put that question, however, in context. Monetary policy does not create all the problems that our economy faces, neither can it solve them all. The increase in the value of the dollar, for example, that took place between the fourth quarter of 1980 and the first quarter of 1985 was not just the consequence of a tight monetary policy pushing up interest rates. It was also the consequence of a horrendously expensive fiscal policy stimulating the economy. It was the combination of a highly expensive fiscal policy creating an enormous deficit, working together with a monetary policy that was aiming at bringing down inflation, that was generating these high interest rates, and the attraction to foreigners of investment in our money and capital markets, and therefore the upward pressure on the value of the dollar. I think as I look back at the past, I can find places where even during the period when I was there, things didn't go as well as I would have liked them to have gone. For example, in the period from roughly October of 1981 until April of 1982, the Federal Reserve was looking for the first time at an extremely unusual development, very, very rapid growth of the monetary aggregates during a recession that was producing no effect at all on the economy. We didn't understand what was happening. And we took a sort of an in-between, middle-of-the-road kind of course of monetary policy. We didn't clamp down so tightly as to choke off altogether that increase in the monetary aggregates, but we did clamp down tightly enough so that interest rates rose during the course of a recession, and that had never happened before. Looking back now, I would like to make different decisions than I myself made at the time. But those are the kinds of things you learn from experience. I think looking overall at what monetary policy has done since the fourth quarter of 1979, bringing down an inflation that was about to destroy our country and our economy, I would have to give the Federal Reserve at least a B+, if not an A-.
Thank you.
By the way, I of course agree with Lyle that most of the problems that relate to the trade deficit and the exchange rate are problems created by the budget deficit and not by the Federal Reserve. Speaking directly, and I rate on a system of 1 to 10, 1 being terrible and 10 being perfect, I give the executive branch in Congress a 0 with respect to budget fiscal policy, but I give the Fed very close to 10. I think for the future, we have to have a development with respect to the fiscal policy which will permit monetary policy to play a more effective role, and I include in that role the exchange rate as part of the objective. I think increasingly we see the exchange rate becoming more explicit in terms of the goals of the Federal Reserve, and shows up in the reports of the monthly meetings of the Open Market Committee. I think we have to move on with more explicit targets or objectives with respect to the exchange rate, state what they are, and seek means to carry them out.
Now, let's entertain some questions from the audience, but before that, let me just say one thing. I always like to put people in this sort of situation. I'd like to ask a question myself first. I'll take the chair's prerogative. And that is, I am going to be a benevolent dictator. No, better than that. I am going to be the person who appoints the benevolent dictator. And first of all, I'm going to appoint Lyle Gramley as dictator and have him conduct the ideal monetary policy. Then I'm going to make Larry Fox the dictator and have him conduct the ideal monetary policy. In other words, what do you think is the ideal monetary policy, and why is that the ideal monetary policy?
It's much easier for me to describe what the ideal monetary policy isn't than to describe what it is. It is not a policy which sets a specific target growth rate for any single monetary aggregate and pursues it no matter what happens. Monetary policy has to adjust to the situation it's facing. And the situation that monetary policy is facing now is very, very different than it was in 1979. So there has to be an adaptation of monetary policy to the current economic circumstances. The reason it's so difficult to predict what monetary policy will be and to assess what it actually has been is that circumstances change, and the monetary aggregates do not have the meaning now that they once did. And I can't give you a better answer than that.
I thought that was a appointed position and not an elected one. You're a great politician.
Well, I think the answer to the question has a lot to do with what's going on with respect to fiscal policy. You can, I think, put up a pretty good monetary policy if you're rather confident that the President and the Congress are moving quite rapidly and steadily toward a budget deficit of close to zero, getting in that direction. Then you can establish your monetary policy primarily in relation to domestic growth objectives and the exchange rate. So I think I'll answer your question in its more difficult phase, namely on the assumption that we're not doing all that well with respect to the budget deficit, which seems to be the situation now, and you have therefore the Federal Reserve in a situation that makes the exchange rate developments that makes the Fed nervous, and it has a situation in which too much monetary ease offers some possibilities of keeping the economy at a little more rapid pace, but invites inflation to take a bigger role as the cheaper dollar makes imports more expensive. Under those conditions, I think the Federal Reserve is doing exactly right now, namely keeping quiet, sitting on its hands, and describing the role that the Congress and the President have to do with respect to budget deficit.
All right, why don't we now open this up? Questions from the audience. Please identify yourself, direct your questions toward one of these two gentlemen. If the other one, of course, wishes to respond, then we'll allow him opportunity to do so. Questions? Yes, ma'am.
My name is Frances Topping. We have been given we know what
the economic situation is at the moment. Therefore, we ought to be able to say what we should do in order to have a better performing economy. I don't think any of us is satisfied with an economy that is only growing at 2%. Is there any prescription that the panelists can offer that could speed up the economy and cure some of the ills along the way, including better collection of more taxes and other benefits from an increased speed up in the economy?
Anyone in particular would you like to address that, or both?
I'd like to have
Okay.
either one.
Either one or both. Let me first say that I am of the thinking that if you want to speed up the economy, an increase in taxes is precisely the wrong thing to do. But now I'll leave it to these other two gentlemen to express their views.
I don't think there's any magic formula we can use at the present time to stimulate a lot more growth relatively soon. I do think monetary policy is facing quite a dilemma at the present time. We're looking at an economy in which the expansion is quite mature. The credit-sensitive sectors of the economy have expanded a great deal. Consumers are quite heavily burdened with debt. We've had 4 years back-to-back of strong housing production. Small declines in interest rates aren't going to do very much. And large declines in interest rates could be quite dangerous in terms of their implications for the dollar through the international side. I think over the longer run, what we need to do to improve the performance of our economy is to work on these imbalances with regard to our twin deficits, the federal budget deficit and the trade deficit. I think Congress is beginning to take action to slow the growth of federal spending. I would expect some progress to be made in fiscal 1987 in bringing down the deficit. Nothing major, but a reduction of perhaps $30 billion or so in the federal deficit. I am also optimistic that we are in a position to see a turn in our trade deficit in real terms also. One of the little-known facts is that our non-farm exports in constant dollar terms are already moving up and rose quite handsomely in 1986. The increase by 10% fourth quarter to fourth quarter. I think the drop in the value of the dollar has improved our competitive position in world markets substantially. The loss of market share by large countries such as Japan and West Germany can't be filled in fully by the newly industrialized countries. They have neither the overall capacity nor the particular kinds of production in which Japan and West Germany are losing market share. So I fully anticipate an improvement in our real net exports of goods and services in 1987, leading to a stronger performing economy in 1988. And I don't think there's much that public policy can do at the moment to accelerate that process.
I don't think that the objective of a perpetual motion machine where the economy is always driven, if it's doing 3%, it ought to do 3.5%, if it's doing 4%, it ought to do 4.5%, if it's doing 2%, it ought to do 2.5%. I don't think under the conditions that now exist, the United States ought to be growing faster than the rest of the world. I think the emphasis of the administration, recently expressed in the Group of 7 meeting in Paris, that the other countries ought to grow more rapidly, taking up part of the slack, taking some of the imports from the third world countries having debt, taking more of the imports from the United States is right, except they don't seem to be buying that particular formulation. Under those circumstances, it seems to me the United States inevitably has to pursue policies of less slower than optimal growth. My formulation would be for the Fed to put as much attention as it can to the exchange rate subject. That is the area of big pluses. If we can get increased exports and hold import growth roughly where it is now, that would add materially to the growth of the growth rate of the economy, and I think that would be the most felicitous avenue to pursue. I think the international monetary system has worked very poorly under the system of floating. The Bretton Woods fixed parity system was abandoned in 1973, and floating has proved itself to be not really very advantageous from the standpoint of either stability or from the standpoint of offering better hopes than the old Bretton Woods system. I think we ought to look for a modification in floating. I think the flexibility is needed, but some approach that combines a higher degree of macroeconomic coordination among the major countries, of course, is desirable, but some more mechanical approaches to the exchange rate, possibly reference zones or target zones or something like that, greater use of coordinated intervention. But I would try, the main point is I would try to get the additional growth in our economy by improvement in net exports, and primarily on the export side rather than through conscious reduction of imports.
Yes, sir.
There's no lack of growth in the stock market, which is sometimes said to be being pushed now by excess liquidity, whatever that is. And my question is there any relationship between this so-called excess liquidity, the Federal Reserve policy, and should the Federal Reserve do something about soaking up this excess amount of money that's in dollars floating around the world?
That's another Gramley question.
I have no doubt that the continuation of a fairly expansive monetary policy for the past 4.5 years has been a factor in the boom in equity prices since the fall of 1985. I don't think there's anything the Federal Reserve can do at the moment to sop up excess liquidity without extremely adverse consequences for the real economy. When your economy is growing at between 2 and 3%, harsh measures to move towards restriction would be most unfortunate. And so I would not advise them to do that, and I don't think they are thinking of doing that. I'd like to make one other comment about the present state of our economy, however, to put this present state of affairs in a broader context. After 6 quarters of very rapid growth from the end of 1982 to the middle of 1984, our economy has slowed down to what we regard as an unsatisfactory growth rate of roughly 2.5%. But 2.5% is approximately equal to our long-term potential growth rate. And therefore, the unemployment rate, although quite high, has been unchanged throughout this period. We tend to get very dissatisfied unless we have anything except the very best. But an economy that's going into a 5th year of recovery, with an inflation rate that has shown no tendency to move up during the course of this recovery, with interest rates that are the lowest they've been in roughly a decade in terms of long-term interest rates, I would say we're doing reasonably well. For the moment, let's not rock the boat too much. Let's give the economy time to get over some of these problems. The problems we're dealing with now, to some degree, are like mononucleosis. It doesn't make you feel very good. You know you're eventually going to get over it, and there's not much you can do about it anyway.
Yes, sir.
My name is Lou Buchever. As I understand the speakers, they seem to feel there's very limited range of influence that the Fed could have now on the U.S. economy and the international situation by changing its policy, but that if Western Europe and Japan were to pursue a more expansionist economic policy, this would certainly be both in our interest and in the general global interest. If this is so clear, why are Western Europe and Japan not expanding more? What influence can we have to move them in that direction? And what is the likelihood that they will move in that direction? Either one or both.
Well, I think in a word, their reactions are perverse. They have learned the lesson, the anti-inflation lesson, too well, and they have forgotten the Keynesian lesson of the value of growth. And they have a wonderful target to explain their perversity, namely the inability of the United States to deal constructively with its budget deficit. The American economy has performed relatively poorly in the international sector. We have, to a degree, lost our credibility as an advisor which other countries would want to follow either directly or through emulation of policy. And I think we have a situation in which bad policy begets bad policy, and there is very little likelihood that we're going to get the kind of sustained growth in Western Europe or Japan that's necessary to alter this balance. I see us, therefore, moving in the direction of a recession. Maybe it won't be a dramatic recession unless there is a bank failure or some other financial collapse. But I think the resumption of healthy growth without a down period is rather unlikely.
Well, perhaps I'm that perennial optimist who sees the world through rose-colored glasses. I do think there's some indication that we will see some more stimulative policies pursued by both Japan and West Germany. West Germany has given a commitment to increase the size of the tax cut it plans to put into effect in the beginning of 1988. Japan lowered its discount rate yet another time to the lowest level ever, 2.5%. It's also indicated that it's going to follow a more expansive policy with regard to government spending. These countries have political difficulties of their own to deal with. Let me remind you that all of us here in this room would widely regard the course of policy followed by a fiscal policy followed by our government from 1981 through 85 as being rather bizarre and inappropriate to world economic circumstances. Foreign countries thought so also, and we were told time and time again by them that we needed to do something about our deficit, and we brushed them away. The fact that they don't follow our requests word for word should not be any great surprise to us.
Yes, ma'am.
Colonel Nelson, the topic of inflation has been touched on several times, and it seems to me the Federal Reserve has been given undue credit for controlling inflation in the early 80s, because a lot of that, it seems to me, was due to the decline in oil prices and the decline in farm prices. And both of those were sort of external shocks that were not necessarily related to tightening the monetary policy. Now, I also think that this next year, inflation as measured by the CPI will be higher than it was last year, because external shocks, OPEC and so on, the oil prices will be increasing. I hope that, in my opinion, I hope that the Fed will not overreact to that increase in inflation by tightening monetary policy. I'd like you both to comment on that.
First, let me say that I have never been a monetarist in any strict sense of the word. I've never believed that in the short run what happens to the money stock is the primary determinant of what happens to prices. I do believe in the short run exogenous factors have a good bit of influence. I would call your attention, however, to the fact that most macroeconomic studies I have seen of the decline in inflation from the double-digit figures of the late 1970s and early 1980s to the roughly 4% underlying rate of inflation now find that that can be explained almost entirely by the increase in the unemployment rate. That is to say, the degree of macroeconomic slack. Now, in addition to that, we had such good fortune as in terms of inflation at least, of falling oil prices, declining agricultural prices, and the appreciation of the dollar. Those helped. But I think the fundamental factor was the degree of slack in the economy, and that was primarily the consequence of a relatively restrictive monetary policy being pursued over an extensive period. Is the Federal Reserve going to become overly concerned about the fact that in 1987 consumer prices will rise about 4% or perhaps a little more compared with 1% in 1986? No, I don't think so. I have read with some care the testimony of Chairman Volcker in connection with the Humphrey Hawkins Monetary Policy Report to the Congress, and I interpret that testimony as indicating that in a worsening of the inflation rate from 1% to 4% would not be considered a fundamental worsening. It would be considered the return of the actual inflation rate to the underlying rate, by which I mean the rate determined by the rate of increase of costs, and would not therefore give rise to a tightening of monetary policy.
Well, my comment is along these lines. The number one job of the Federal Reserve is to avoid inflation. it shouldn't be to make the economy go a little faster than it's going. There's a role for fiscal policy in the latter objective. Unfortunately, we've run out of tools with the size of the deficit that we have, and my opinion is we're going to have to pay the piper, which means we're going to have a degree of relatively slow growth and perhaps moderate inflation. And if we push too hard for faster growth, we'll pay for it in higher inflation.
Yes, sir.
Bob Waters for Larry Fox. I was wondering where the exports are going to come from. I mean, who's going to buy these exports, and if they're LDCs, how are they going to pay for them?
Well, my view is that Lyle's figures on the improvement in net exports are really quite optimistic. One of our problems in solving our trade situation in a non-protectionist way is the problem that you raised. To whom will we export? Our trouble is there's not another United States out there to export to. We have to export to Latin America that's run out of money. Some people would say Europe could be another United States and buy from us a great deal, but that's not really their style. They really have a view that they have to grow further, primarily emphasizing the manufacturing sector. They've got to compete with Boeing through Airbus, no matter how large the subsidies are, and somehow it's the United States' job to continue to grow, solve its trade deficit, absorb those cheap goods from the Far East, and do so in an agreeable way and not create too much fuss about the exchange rate. I think there's an unrealistic view in Europe about how the United States can change its trade balance around without Europe altering its position dramatically. To say something positive, since I'm not really very optimistic about Europe making a big contribution, I think a more fundamental and longer range address to the developing country debt problem would help us a great deal. Most sectors of American industry that had a position in Latin America have seen their exports to that region reduced by as much as 40%. And I think dealing with the debt problem in Latin America would be constructive from just about any point of view.
Thank you for coming.